The world economy is a complex, interconnected machine. But in 2008, that machine shuddered to a halt. What followed was the most severe economic disaster since the Great Depression of the 1930s. This is the full story of the 2008 financial crisis. Our story begins in the early 2000s with a period of unusually low interest rates and a flood of foreign investment into the United States. This cheap credit made it easier than ever for people to buy homes, fueling a massive boom in the housing market. Prices soared, creating what we now know as the US housing bubble. Financial innovation ran rampant. Lenders offered increasingly risky subprime mortgages to borrowers with poor credit history, often with deceptive terms. These weren't just isolated loans. Investment banks bundled thousands of them together to create complex financial products called mortgage-backed securities, or MBS. Rating agencies stamped these toxic assets with their highest AAA rating, deeming them as safe as government bonds. These securities were then sold to financial institutions around the globe, from pension funds to commercial banks, all chasing higher returns. The system was a house of cards, built on the assumption that house prices would never fall. But they did. By 2007, the bubble began to burst. Homeowners, unable to keep up with their mortgage payments, started to default in record numbers. As defaults rose, the value of the mortgage-backed securities tied to them plummeted. The house of cards began to wobble. The crisis hit its terrifying climax in September 2008. On September 15th, Lehman Brothers, a 158-year-old investment banking giant, filed for the largest bankruptcy in US history. Its collapse sent a shockwave of panic across the global financial system. Credit markets froze. Banks stopped lending to each other, fearing they might be next to fail. The stock market crashed, wiping out trillions of dollars in wealth. Around the world, there were runs on banks as terrified citizens rushed to withdraw their savings. Governments and central banks were forced to intervene on an unprecedented scale. In the United States, the government passed the Troubled Asset Relief Program, or TOP, a $700 billion bailout package to stabilize the collapsing financial sector. The Federal Reserve slashed interest rates to zero and pumped trillions of dollars into the economy. Similar rescue plans were enacted across Europe and Asia. The immediate financial panic may have subsided, but the world was plunged into the Great Recession. Millions of people lost their jobs, their homes, and their life savings. The crisis exposed deep flaws in the financial system and led to sweeping regulatory reforms, like the Dodd-Frank Act in the US, aimed at preventing a repeat of the disaster. The 2008 financial crisis was a painful lesson in the dangers of unchecked speculation, greed, and regulatory failure. It reshaped our global economy, and its effects are still felt today, a stark reminder of how close we came to a total collapse.